Today's Did You Know real estate number is 6.74. That's the average interest rate today on an FHA 30-year mortgage. This is the First Time Keys podcast. Welcome in. I'm your host, Adam McCallister, and thank you for making this part of your listening day. I do so appreciate it. Do me a favor, if you would, hit the like and subscribe button. That way we can continue bringing you great episodes and continuing to grow. And talking about that for just a moment, I want to thank you for being here early in this podcast with me as I continue to hone this down and make this better each and every episode. I realize as I was listening through the first few, it's a little rough, but anytime you're starting something new, it takes a little while to find your legs. And I think with each and every episode, we're going to continue to get better. And it's my goal, it is my promise to you that every episode we continue to exceed the previous episode's quality. And again, I just want to thank you for being here in the early stages and the early days of this podcast and giving me this opportunity to grow with you and for you to grow with me and make this something really special. Speaking of special, it's now official. The Philadelphia Eagles have knocked off the Kansas City Chiefs. They are this year's Super Bowl champions. Congratulations to the Eagles. Congratulations to all my friends who are Philadelphia Eagles fans. And you guys can now ride high for another year. And just know that pretty much everyone outside of Kansas City thanks you for putting an end to the Chiefs dynasty. Is it fair to say that? At least knocking off Mahomes and Kelsey for another year. And we'll see what happens next year. We're now, 2 days into Kendrick Lamar Gate? Is that fair? Where you have a large percentage of folks who love the Super Bowl halftime show. And then I would say you had those that, didn't. I admittedly was in the group of, not for me. I enjoyed the performance. And I mean, Kendrick was sweating his butt off. So you could tell the time, the artistry and all that went into it. And after it was over and getting to see some of the explanations for what I missed in the in the live version and being able to go back and see the game that he was playing at halftime, that was cool. Like that was 3D level chess that he had going on there. And I realize why he is the decorated artist that he is. So that was amazing. Now, on social media where, everything is wonderful and rainbows and sunshine and puppy dogs, there were a few, including some of my Gen X brethren, who were complaining that they couldn't understand the thing that Kendrick Lamar was saying. And to you fellow Gen Xers, I go, we were raised on Pearl Jam and Eddie Vedder and Kurt Cobain with Nirvana. And if you can tell me honestly that you knew what they were saying, I mean, even Eddie doesn't know what Eddie was saying. It sounded good, but Eddie doesn't know. So just chill with the whole, we couldn't understand anything. Here's the deal. The beats were great. I enjoyed the beats. I enjoyed the music behind it. It was fun. It was great. I'm looking forward to next year. We'll see what happens. So speaking of things that some folks don't understand, today we're going to talk about interest rates. That's right. We started at the top of the show with today's current FHA interest rate, which is 6.74. And for the better part of the last year, that's kind of where they've been hovering. Anywhere from the low sixes up to 7. So they've sort of been hanging in that 6% interest rate fluctuation, never not crazy too high over 7s, never dipping below 6. So that's kind of where things have been. They've been consistent. They've been steady. And I wanted to have a good friend of mine and someone who really can dig into the minutia. So if you like data and you like numbers and you enjoy how the sausage gets made, this is the show for you today. So our guest today is Carl Delmont. He is the owner, CEO of Freedmont Mortgage. Been at this for a long time. And he really gets down into the nitty gritty and explaining why interest rates are where they are, as well as predicting and looking ahead to where he thinks things are going to be at. And most importantly, what actually affects interest rates when it comes to mortgages. Because we hear on the news all the time, the Fed's coming out and they're going to lower interest rates by 0.25% or 0.5%. But does that really have any impact on mortgage rates? Because I think for most folks, they go, oh, we hear rates went down, so therefore that's going to impact mortgages. And it's not necessarily the case. So rather than waste a whole lot of time with me trying to explain it, let's get into this interview with Carl Delmont from Freedmont Mortgage. This is the First Time Keys podcast. Joining us today, one of the smartest financial minds I know. And I don't know that many people, so therefore the bar is rather low. But a good friend of mine and the owner of Freedmont Mortgage, Mr. Carl Delmont. Carl, how you doing today, man?
I'm doing well. Thank you for having me.
Absolutely. Where are you joining us from today?
From the confines of my house due to the weather.
Nice. So I never know where Carl is. So not only does Carl, is he the owner of Freedmont Mortgage, he also owns the Harrisburg Heat, which is a professional indoor soccer team here in South Central PA. He coaches girls college soccer. You're always on the road. You're always on the pitch somewhere. So I never know where I'm ever going to find you.
Yeah, I'm kind of easy to reach, but kind of hard to catch.
That's right. So, reason for wanting to have the conversation with you today is, as we're talking and looking at mortgage rates, we saw them last year in the sixes. Now they're in the low sevens. Let's have the conversation. What does affect mortgage rates?
Well, I mean, a lot of people think it's the Fed, but it really isn't. Mortgage-backed securities, treasuries, things of that nature, are really what's going to dictate mortgage rates. The Fed, when the Fed talks about lowering rates or raising rates, that's the federal funds rate. What you'll see there is an immediate impact on home equity lines, maybe some credit cards, anything that's tied to prime. So if you have any loan tied to prime, when the Fed does action, that's when you'll see that. But I've said this before. I said it when the Fed first started cutting rates back September. In August, I'm like, look, the Fed's probably going to cut rates. But for those people who are waiting, I'm going to wait for the Fed because rates are going to drop. I told them, I said, here's what's going to happen. Rates are going to stay the same or go up. And here's the sad thing. I had some people in the industry text me or message me like, what you're talking about, you're giving bad advice, whatever. Well, guess what? Every time the Fed did something, rates went up. And the reason is the bond market is ahead of the Fed. They are anticipating what's going on. So if the Fed's going to lower rates, the bond market's already taken that into an account. Now, if the Fed comes out and lowers rates like the bond market expected, you're not going to see any reaction because they've already kind of baked it in, right? If the Fed does something counterintuitive, if all of a sudden they raise rates, then you'll see the markets react and then mortgage rates will follow. But here's the simplest axiom I can tell people, and this is held true the majority of the time. If there's bad economic news, you're going to see an improvement in mortgage rates. If there's good economic news, not so much. So, you look at the jobs report, you look at different things. So, in the month of February, we're doing this before the jobs report. The ADP numbers came out on Wednesday, a couple of days ahead of the jobs report, and they came out at 185,000. That's private payrolls, a little bit higher than was expected. We'll see what happens there. But manufacturing came down to a 52.8 from a 54 month over month. 50 on the ISM index is basically neutral. Anything below is contraction. Anything above is expansion. So we're kind of neutral there. I think right now what we're seeing is just the fear of uncertainty with tariffs, right? President Trump came out and threatened Mexico and Canada. He just gave a 30-day reprieve, but they seem to have acquiesced. Mexico said they're going to put more people on the border. They're going to try to stop more of the fentanyl trade coming in. Canada the same. China's kind of fighting back a little bit, but when you come in and disrupt things, that's when you see a lot of uncertainty, and that could be good for mortgage rates, but then again, it could be bad for our pocketbook. So you have to kind of see which one you wish for.
So, and that seems to be the dance that happens between people want low mortgage rates, but in order to get low mortgage rates, you have to have something catastrophic happen to the everyday economy. Is that fair to say?
Well, here's a good recent example. Go back to COVID. Lowest rates we've seen in ever. right? But we couldn't afford toilet paper. We couldn't find toilet paper. You weren't allowed to go to restaurants. You weren't allowed to go out. You mentioned soccer. We weren't allowed to coach. I mean, there was a lot of crazy things going on. I mean, I remember, sitting in your house for a week and a half, just thinking, okay, this is kind of like a movie. What's going on here? But at the same time, you had rates that were at record lows. I think what's happening now, though, is the public is starting to, and it always takes a while, right? They are starting to become a little more acclimated with, I guess this is the new norm. And I think it's also a combination of some people are like, you know what? Yeah, I got a great rate, but I have a 2-bedroom condo and now I have 3 kids. So I need a bigger house. And yeah, it's going to be a higher rate, but it's like anything else. Like if your car is on its last leg, you probably don't want to buy a new car, but you also realize there's no cost efficiency in continuing to put money into something that's just going to, keep eating all your money. So you bite the bullet, you buy a new car. But I think once people are educated and understand what's going on, we'll see more people not in that, what they call that rate lock mentality where like, I can't leave, I can't give up my rate, they're married to the rate. And, there's justification for that. But again, if you're in a school district that you're not happy with and you can't put your kid in a magnet school, you're in a house that needs too much work, or maybe it's too big a house. Maybe you just, you're empty nesters now and you just don't need all that, that house or the maintenance cost, or, the house is too small. Then you have to look and see what options are. And there's a lot of great options out there. There's grant programs out there that can help you with no money down. There's, USDA is another great program where the monthly mortgage insurance is minimal. I always argued that USDA and VA are 100% financing programs, and they have some of the lowest delinquency rates out there. So there's people who argue, oh, if you don't put any money down, you have no skin in the game. Those are the high delinquencies. Not really. It's the ones with a little bit aggressive underwriting, like FHA. You'll see a higher delinquency rate there just because the underwriting is a little bit more aggressive. 3.5% down, but you have higher monthly mortgage insurance components. So what we are seeing now, though, are people who have FHA loans and then turning around and refinancing, even though it's a higher rate, to a conventional, because they have a lot of equity. They're able to consolidate some bills and they're getting rid of that mortgage insurance component. So imagine freeing up cash flow, even though it's a little bit higher rate. That's where, again, education makes a lot of sense. People who are just rate sensitive, look at the big picture, because sometimes, you might be able to refinance. And even though we've given up a low rate for a slightly higher rate, if you put an extra $300-$400 in your pocket a month, that may be important.
Yeah, and for a home buyer, I know what Angela and I did several years ago, talking about going back to pre-COVID. We initially bought this house with an FHA, refinanced it a year later, took some of that equity and then refinanced into a conventional, and then bought an investment property with that equity. That way, what it cost us to do it, we're more than doubling that with the investment from that rental. Not to mention the accrued interest or the accrued equity that's happening in that investment property. So you can be very financially smart once you get into your home and be able to use these mortgages to the best of your benefit, and not just go off of what some guru might be telling you that you only have to do one type of mortgage. I think the most important thing is secure the house. That makes sense for you financially right now. So if you're talking to a first-time home buyer, Carl, what advice are you giving them mortgage-wise that you think would be best to their benefit?
Well, I think when you're talking to a first-time home buyer, you want to talk to them. They're new to this, right? And let's be honest, the advice they're getting is from their parents, older siblings. If you bought a house 4 years ago, buying today, different experience. But they trust those people. But they bought one house in a unique time in the history of finance. And whereas, someone like yourself, an experienced realtor, or, people at our team at Fremont who've been doing this forever, we've bobbed and weaved through all these things. We know what's going on. We're doing tons of these each month. So we're in tune with what's going on with the trends and what, that makes sense. So we try to encourage and educate our first time buyers, and you talk to them like, what are your goals? What are you trying to accomplish? If they need a realtor, we can introduce them to a realtor. But it's really going over the programs. And what I always tell people is, look, if you have 20% down, that's great. But don't just go and blindly put 20% down. Look at your options, because there's an opportunity cost there. If you could put, and I'll give you an example, and I bought my house many, many years ago. I put 15% down. I didn't want to use all my money. And then literally, almost like a year and a half, 2 years later, when I was loud, I refinanced, got rid of that little bit of monthly mortgage insurance, but I kept some of that cash for emergencies because you never know what's going to happen, right? If you put an example I give people, I won't use a first time buyer here, but let's use, say, a recently divorced person. I had this happen several years ago. This lady didn't work. She was a stay home mom, got divorced, got $200,000 in the settlement. Her lawyer's like, oh, you got to put the whole thing down. You don't want a mortgage payment. And my advice was, well, okay, if she does that, let's say she finds someone, gets married, and wants to move. Yeah, she has a free and clear house, but she has no money. What happens if other things are going on? So I showed him, what if she only puts smaller amount down? And the idea was he didn't want her to have a payment. I don't remember what the numbers were, but let's just say a payment more than $1,000 a month. Well, by putting less down, she had a bigger mortgage payment. Let's call it $1,250. So what I said was, why don't we put 20% down, keep the rest of the money, and then what she can do is, if she's comfortable with $1,000 a month, what we do is on the first of the month, she puts in $1,000 to a money market account that holds the rest of that money. On the third of the month, the mortgage company debits the $1,250. So she's only paying $1,000. She's comfortable with her payment. She still has all this money in the bank, right? And to your point, maybe she wants to buy an investment property, maybe she wants to travel, whatever. But now she has that cash. What a lot of people don't realize is if you put 50% down, yes, you have a smaller mortgage payment. But if you ever need that money, you got to call us or some other lender to borrow and pay interest on your money to get it back out. And I
Right.
always find it a little bit weird when someone sells a house that they've been in for, say, 4 or 5 years, and that money, that quote profit, is tax free. And they take that money and put it in 100% down on a property, or not 100%, say 40% down, whatever, and they have no access to that money anymore. So, with today's rates and everything else, just look at all your options. So for a first-time buyer, look at the option. You might, in Maryland, for example, we have a program that first-time buyers, you can buy a house and pay off your student loans. They pay off your student loans when you buy a house. A lot of people don't understand that program. Pennsylvania, a lot of great grant programs. PHFA combined with, an FHA or some other things that you can get it with no money down, and your mortgage insurance component is not as high. So I mean, there's just a lot of options, but explore all your options. When you go to a restaurant, do you just pick the first thing on the menu? No, you look at all those things, and I think that's just a meal. When you buy a house, our tagline: don't make a 30-year mistake by choosing the wrong lender. Don't make a 30-year mistake by choosing the wrong mortgage either.
Correct. There are so many out there, and I think people hear, oh, well, my sister, they bought a house with FHA, so I got to use FHA because I don't want to
Mhm.
put a whole lot of money down. Or, I was listening to mom and dad, and mom and dad were like, no, you got to put 20% down, and if I don't put 20% down, then I can't buy a house. Or insert example here, and it's just having that time to be able to educate someone in the mortgage process of going, well, let's take a look at your individual finances and find out what makes the most amount of sense. So, where do you find that ability, or where do you find that openness with folks when you're talking to them when it's time to do their mortgage to go, no, let's really peel back this onion and see what's going to be the best fit?
Yeah, I mean, some people come in with preconceived ideas, up to your point, oh, my brother did or FHA, we're doing FHA, or, they have a realtor's like, you have to do this program. And we always say, look, if that's what your realtor recommends, we'll go over the program, but, give us 10 minutes to go over a couple others as well. Unfortunately, there's some loan officers out there and lenders that they only push one product. They want to be the largest FHA lender in the state or the county or whatever. So they're going to push FHA. It's not a one size fits all. We had one the other day where this guy is actually, my daughter referred him to me. She was talking to this guy who's thought had everything down pat for his VA loan as a veteran. And he's like, oh no, I'm great. I found a lender. They're helping me out. And anyway, in the conversation, he had mentioned to my daughter that, he suffered a disability while, serving. And so I said, well, give me his number. I'll call him. So we talked to him. And I said, did they tell you that if you're more than 10% disabled, you don't have to pay the VA insurance component? He's like, what are you talking about? I'm like, yeah, they didn't mention that to you? And he's like, no. I said, well, no disrespect. I mean, you sound in love with this lender, but you're about to spend a lot more money because they didn't tell you something that you're entitled to. And he's like, wow, I didn't know that. So, again, it's, everyone's human. Sometimes you don't know all the programs and everything else. But what I always tell people is when you call a loan officer and you ask them about, oh, do you do the 2 or 3K loan? And they're like, oh, let me see. Oh yeah, here it is. We do it. That's a pretty good sign that it's kind of like, you go to a restaurant and they're like, do you have tuna salad? When was it last made? I don't know. I think a couple of weeks ago, maybe. Like that's a sign that they really don't push that product too much. Same with, and again, it goes back to when you're buying a house, I make the joke, it's kind of like a marriage, right? Marriage and buying a house are pretty easy. Getting out of a marriage and getting out of a house, not so much. There's costs and other things involved. So, when you look at all those things, you do want to make sure that you've done your due diligence. You found a loan officer. And one of the things I always tell people, when you're meeting a realtor or a loan officer, think of it as a hiring experience. You're hiring them. Do the interview, ask them questions. If you want to buy a house in, say, York City, like, near you, and they're talking to someone who specializes in equine farms, I don't know it's going to be a great experience, right? And the same thing if they're talking to a lender, and the one question I always ask is like, when you're talking to loans, I ask them, do you own a house? And if they don't, it shouldn't be the reason not to use them, but what personal experience can they bring to the equation?
Without a doubt, we just talked about that twice in the last two episodes, and one of them being with a past client who was VA,
Mm-hmm.
and they went with a VA lender that markets and does a lot on base. And unfortunately, they're not always the best resource to use, even though you use them for your daily checking and savings. They might not be specialized when it comes to doing mortgages.
Yeah.
And that is, I think, one of the biggest mistakes I see make is that, oh, we bank with so and so. They already handle our money, so we'll just go ahead and allow them to do our mortgage. And they might not be great at mortgages. They may do a phenomenal job at checking accounts, but not necessarily. Some banks and lending institutions actually third party out their mortgage company. So having those conversations and talking to someone who know we do mortgages, and Carl, is it okay for a first time home buyer or any home buyer to be financially illiterate, that and admit it and go, tell me what I don't know so we can make the best decision?
Yeah, and I think it starts with building that trust and that relationship because to your point, oh yeah, my dad banks there. We have an account there, so we're going to go with that. What I always tell people is we are what's called a non-bank lender, meaning we do mortgages. We don't offer checking accounts. I don't offer CDs. I don't do car loans. We do mortgages. That's it. We also do commercial loans, SBA loans, but we're strictly mortgages. And when you look at that, that is our experience, our realm. That's everything we try to do, and we're very, very transactional based. And we're looking at we want to work with the client, and we want to make sure that they have a great experience. And our goal is to get not only a great rating, but to get some referrals and to get that repeat business down the road. And we do. We get a lot of people who we look at our surveys. Oh, this is my fifth time dealing with you, or I just sent my kid to you, or and I think that's the ultimate compliment that's showing that you make all those different choices. Again, we live in a world now, especially with the younger market. And what's interesting is the average age, the median age of home buyers is gone up dramatically. I think partly just because insurance costs, taxes, home prices, rates, it's make it a little bit harder. But there are some programs out there for first time buyers. We're still doing a lot of loans for people in their early 20s. They got good credit. They've got some money saved up and, they're looking to buy. But unfortunately, that demographic, they think that the guy doing the TikTok reels is an expert. And I look at some of these things and I'm like, okay, that's not true. That's like, they'll list like six things and two of them are sort of true, but the rest, not even close. But people believe it. It's like, oh my God, this guy, he's got 7 million followers. He must know what he's doing. He's got 7 million followers because you're all a bunch of lemmings. And you think that because he has so many followers, he's an expert, and half the time you find these guys like posing in front of a house. I own 6 houses. He don't own anything. He's just posing in front of someone else's Lamborghini and pulling up to Charlie Sheen's house and saying, hey, this is my mansion.
Oh, you've seen those real estate videos.
Yeah.
We all know who those realtors are. Yes. So, all right. So I'm looking at the markets. We're a few minutes away from the market opening today, and right now it looks like SPY is up. What does that mean anything for mortgage rates? So if somebody's watching the financial news and it's like, oh, it was a great day on the market. does that have any impact whatsoever on mortgage rates?
I think if you're looking at buying or refinancing and you want to do it as if you're a day trader, you're going to get burned. The market is fickle. We prognosticate what we think is going to happen. We don't know. I mean, everything could be trending right now for rates to drop based on some economic news, and then you could have something pop up overseas that wasn't expected. You could have a policy come out in DC that wasn't expected. I mean, you could have a lot of things that happen that just automatically, just without any warning, next thing you know, rates shoot up. So, for those people who try to time the market, God bless you. But I mean, even Warren Buffett, who's recognized as the top, investment person out there, he'll tell you, I've been very rare buying at the bottom, and I've been very rare selling at the top. I mean, and he does it full time for a living. But yeah, I mean, I think when you're looking at rates, just here's what I tell, especially first time buyers, but really anybody from a mortgage process, we look at gross numbers, right? And we're not looking at your cell phone bill. We're not looking at your car insurance. We're not looking at those things. So, when you get pre-qualified, you maybe get pre-qualified as a first-time buyer for $350,000, but that's based on what the estimated taxes and insurance are. And on paper, maybe you do qualify for that. But what you really should do is sit down and look at what your expenses are now and what are you comfortable with, and then have a cushion in there, because when you own a house, if I don't know, the hot water heater goes up, you got to fix it. If you're renting, the landlord has to fix it. So, if you get approved for 350, maybe don't look at that. Look at, I'm comfortable with, I'm making up numbers here, $1,800. We're paying $1,600 in rent. $1,800 seems like a pretty good number where we still have money left over. We're not eating cat food once a week. We've got money to go out to dinner, maybe movies, have a life, and more importantly, build savings, right? Investments for retirement, etc. So then you turn around and look at that versus, oh, I qualify for 350, because then you get caught up. And most people, they find a way to swing it. But do you really want to be house poor? I don't think anyone does, especially in the uncertain times with inflation and everything else. So, do your own budget, figure out what you're comfortable with monthly, and then tell your loan officer, this is where I want to be. And it may end up being you buy a less expensive house because the property taxes are higher, or maybe you find a house that's a little bit farther out, but the taxes, insurance are cheaper. You get a little bit more house for the money, and it falls within your monthly budget. The other thing is, and you probably advise your clients of this, ask the client, the seller, do you have your last 12 months utility bills? Get an idea what your costs are going to be, because in your apartment, you might pay $150 a month. In this house, because, if you got some older windows or whatever, maybe it's $300 a month. And if you're not expecting that, for the first time buyer, $150 a month net could be, a little bit painful.
Oh yeah, and it sometimes goes the opposite way. If I've got folks that are moving up from Maryland into PA, they see a dramatic decrease in their monthly bills.
Mm-hmm.
For most of the time when it comes to car insurance and cost of living and all that, normally I've got folks that are coming up from Maryland into PA going, oh wow, we've actually got more money in our pocket now than what we had, living across the line. So two quick questions I have, and I'll let you get going, Carl. And again, I appreciate all the time.
No problem.
For someone who says, hey, yeah, I need to buy a house, but I'm just going to wait for rates to drop because, I'm smarter than the market. I know what's going on. These rates are completely inflated. I know they're going to drop again. We're going to be back into the threes, and that's when I'm going to buy. What advice would you give them?
I say no matter what rates are, whether at the lowest or at the highest, the best time to buy is when you're financially and emotionally ready. It's a financial decision, but there's emotions that come along, and emotions usually cloud our financial decisions. If rates are today, say 7, and they shoot to 8, then yeah, I think that rationale makes a little bit of sense. Let's see if this is just an aberration, it's going to change. But if you're just sitting every day like, oh, rates moved up a quarter, rates moved down an eighth, trust me, you just better things to do with your life. But as far as waiting, here's what happens in basic economics. If today's average house price is, say, in your market, 310, and rates go down, the average price is probably going to go up to 340 pretty quickly.
Yeah.
So if rates drop a half, but the property cost goes up, you didn't really save anything. You might have got a little bit lower rate, but you got a bigger payment. Would you rather have a little bit higher rate, get the equity, refinance? Now you got the lower rate and the equity. that's probably the strategy. So if you're emotionally, financially ready to buy, then now it's probably a good time. If you're not, then just be honest with yourself and then wait. But trying to time the market is a fool's game.
Yeah, I mean, for the last couple of years, you've had a lot of realtors, saying the very catchy, marry the house and date the rate.
Mhm.
And at times where you go, okay, that kind of gets a little cringy. It's still true because go find the house that matters for you, that meets your needs, because that rate's constantly going to change. And when it's where it's at, maybe that's when you bought. But if it goes lower, well, now be the smart consumer and take advantage of it, refinance, lower your payments, and utilize some of that equity.
Yeah, and I think the best advice is find a good lender, find out all the options for your programs, get the pre-approval, understanding that, if you wait 2 months, you have to get it updated or whatever, but at least you had that relationship and they're on call. Then find a good realtor and tell them what you're looking for. They may not, what you're looking for, it may not be available every now and then, but in life, we've learned this, right? You tell someone something and you're either 2 weeks too late or you're 2 weeks or a month early. And you've probably seen this, but I've had clients who tell me, oh my God, we were looking, nothing. We kind of gave up. And a month later, a realtor called, and this house is about to come on the market and has everything we want. The location, it even has a pool. It has this, and it's like I tell you, like it's what's meant to be will happen. But be proactive. Find out what your options are. Work towards building your credit scores. Get them even if you're 750, get them higher. Can't hurt. And then turn around and, like I said, find a realtor that you like, interview them, and if you like them, just tell them what you're looking for. And it may not be available today, but at some point, you might get a pocket listing. You might get a seller calling you saying, "Hey, we're going to list our house in 2 months." Um, and you could say, "I have a buyer now that's willing to do it," and they'll give you 2 months, like when you're ready to move. Maybe that seller's waiting for their house to come, be built or whatever. You can time perfectly, and everything works out nicely. So, again, be proactive. But most important thing, find a great lender that you trust. Find a great realtor that you trust. And you've been doing this a long time. You're great at what you do. We love working with you. So hopefully people watching this are going to learn a little something and maybe hire you to be the realtor.
That's how this works. Yes, I mean,
Yep.
but to go in all seriousness, to go back to what you were just saying, with when you're buying a house, selling a house, you never know when life is going to happen. And some people think, oh, well, no, this is all staged and it's all, this house is going to hit here and why. And it's like, no, there was a divorce, there was a job
Mhm.
relocation, there was a new baby that came along, there was life, and I think people sometimes forget about that with what we do. We work with people. And when you've got people, you deal with people issues, and that's life. So it's you never know when things are going to happen, and that's why you never know when that perfect home, that perfect mortgage is going to show up for you. But the only thing you can do is be prepared. All right,
Yep.
Carl, I need you to get it. Go ahead, put on your amazing Karnak hat and grab your crystal ball and prognosticate what do you foresee for rates and mortgages for 2025? Because there are some people who are going, wait a minute, when this guy was in office before, money was free and he's going to be bringing that back to us. Is that the case, or what does Carl the Magnificent see for 25 and 26?
Now, when you look at the national debt and with rates higher, we got to turn around and refinance. The government's refinance that debt with new issuance at higher rates. So then all of a sudden the carrying cost goes up. Imagine, you transfer your credit card of say $20,000 balance to a new card at 0%. You're excited until that three month window ends, and now you're 3% higher than your old rate. So we look at that. That's and there's going to be demand for our treasuries and our currency. I mean, sorry, our debt. Bank of England just lowered their rate. They just cut rates. So it's interesting to see how that'll work. But I think when you look at the coming year, I think, somewhere in the sixes is historically for a 30-year rate, it's a great rate. We're just a little bit jaded because we were used to 2020, 21, those rates. And as we distance ourselves from that, I think people are starting to realize what the norm is. If you look at the last, say, 20 years of mortgage rates, sixes are probably normal. I think we'll get down there. Fannie Mae seems to think we'll see a couple small refi booms, very short lived, but we'll have to see. But I think right now it's really, really difficult to give any type of serious prediction simply because we're so new in this administration and there's a lot of things that they're saying they're going to do, whether they're campaign promises or just red herrings to make other countries negotiate, whatever. Until we know what those are, all those things are just, potential, landmines that could impact things. So the economy in some ways seems to be showing signs that it might be slowing a little bit. If that's the case, then, that could help rates somewhat. I am confident in saying we're not going to go back to the rates we saw in 2020, 21. But, will we get in the fives? I don't see that in the near future. But, if rates come down in the sixes, stay there. The other thing is, and you can probably, attest to this, sometimes when you're negotiating to buy a house, if you're not comfortable if rates are, say, 7, but you're really counting on 6.5, tell the seller, give them their asking price, but say, instead of knocking 10,000 off, how about you pay a point, right? Now you get a really low rate. The seller's happy, you're happy, and then you got the rate you wanted. There's buy downs and things as well, so there's different ways to do it. But I think we'll see rates improve from where we are today, not significantly though.
So you would say within a point of where we currently are is what you would see for the year. We might see
I'd say
sixes,
3.5
but
a point to a point would be the point being the more optimistic side of it. But again, there's just so many uncertainties that could throw curveballs at us. So and again, if we were 1 year in, I'd have a little better feel for what's going on. But we're only a couple weeks in, and again, there's just a lot of uncertainties. But overall, housing has always done well. We had the Great Recession where we had some people underwater for a while, but that I think was more attributable to just slack underwriting, a lot of crazy programs. Remember we called them the stripper programs. Like you had to show anything. You had cash, sure, you could buy a house. No doc, no this. Just they've come back, but they're highly regulated. You really got to qualify. The bank statement program, because look, the small business owner, maybe he only shows $40,000 a year, but he's already got a nice house, he's got a car, he's paying his bills, he got a lot of write-offs. So that 40,000 goes a long way, and then maybe there's some money that his business is paying for his cars or things like that. But so there's programs out there for those people as well. But overall, I think rates, they'll be a little bit better than today, but they could also shoot up temporarily and they can come back down temporarily. But I think this is the new norm. And I think more and more of consumers are starting to, I guess, believe that and subscribe to it.
So your advice is quit worrying about the rate. And when the time is right and the house is right, jump on it and do it. Is that fair to say?
Let me ask you this. When you bought your first house, what was the rate?
6.25 back in '99.
Okay, so we're close to that, right?
Right.
I bought my first house. Rates, the builder bought down a rate, and I was still 8.5. Rates were almost double digits. So you look at those things, and it's all a factor of what's going on in the economy. The difference, though, is your first house. I'm going to guess you probably paid under 100,000.
Oh yeah. I remember 89.9. We got 6% seller help. And the rate was 6.25. And I remember my parents going, "Oh my God, that's an amazing rate. You need to jump on that." And I was 22, 23 years old. And I'm like, sure, I got no idea what I'm doing. I just know I'm getting a house.
Yeah. And your homeowner's insurance is probably 300 a year, not,
Oh yeah.
3,000.
Yep.
So I mean, all these things are going up.
Yeah.
And again, that's what you want to understand, the emotionally and financial aspect of it. Understand all the potential costs. That's why I suggested they'll get 12 months or even 6 months of the utility bills. Look at the taxes. Look at your insurance. All those things. Because you're renting, you may have renter's insurance, but it's nowhere near the cost of homeowner's insurance. So you want to look at all those factors and understand what your monthly outgo is going to be, and make sure that you're comfortable financially, because the last thing you want is a ton of stress. Home buying should be a way for you to improve your financial outlook. And look, let's be honest, with everything that's going on today, homeowners, that's a big chunk of their retirement.
Oh, without a doubt. I mean, you talk about keeping it stress-free. I mean, the number one reason for divorce is financial strain.
Yep.
So you don't want to add extra onto that. And the last thing I want to do is see any of my clients, down on ramen noodles and 6-month-old hot dogs. So no, make smart financial choices. All right, Carl, one last question, and then we'll let you go. Best investment strategy this year, real estate or eggs?
Well, I don't know. Someone just stole $100,000 worth of eggs in Pennsylvania. Did you see
Saw
that?
that.
Yeah.
Yeah.
So I don't know. That's an interesting question. Hey, look, historically, real estate does well. But again, not everyone should be a homeowner. If you have a job that is typically transient, you don't like responsibility, renting, there's nothing wrong with that. And there's a lot of people out there that rent their whole entire life. It's not, it's really a personal choice. But if you, again, I hate to sound like a broken record, if you're financially, emotionally ready, I think that's the best time to buy a house.
Absolutely. Carl, thank you so much. And if people want more information, they want to connect with you, where should they go?
Yeah, you can find us 24/7 at Freedmont, FREEDMONT.com, and last number 1846 or 800-955-8508. We have people on standby evenings and weekends. We give a complimentary home warranty and qualifying purchases. And most importantly, we never charge an application fee. So if you want to find what the options are without any kind of stress or cost, we're here for you. And
Carl,
for the last
appreciate
37 years.
That's right. Yes. All right. Carl, appreciate it. Thank you again for all your time. And we'll be right back after this. Oh, hope you guys enjoyed that. I know I got a ton of great information and learned a couple things myself from Carl. So hope you did as well. And if there's, I think the biggest lesson of that is don't get frozen because of an interest rate. If you can afford the house and it's the house, I mean, don't settle. We've talked about that. We've talked about that here on this podcast, where don't get tunnel vision and don't think that you have to settle. But if this is the house and you can afford the payment and you're not going to be forced on ramen noodles and 6-month-old hot dogs for the next year, take the leap, get the house, and don't be worried about interest rates. Because as Carl told us, it would take something seriously catastrophic for interest rates to go back down where they were 4 or 5 years ago. And the question is, would you rather deal with an interest rate where it's at right now and then down the road be able to refinance and get the lower interest rate, take advantage of that, of your home's equity then at that time, or have a catastrophic event, which sure will lower interest rates, but in the process will take prices higher, meaning that you're really not gaining anything. So grab the house, make it home, and enjoy it. And then again, don't be scared off by interest rates. So again, hope you guys enjoyed the episode. Hope you got something from it. Next episode, I'm going to be breaking down the actual home buying process. That's right. If you're like many that I talk to and they go, Adam, we want to buy a house, but what does this actually look like? I'm going to break down each spot that you're going to hit as you go along the process of your home journey. So I'll open this whole thing up in the very next episode. With that, this has been the First Time Keys podcast. Your host, Adam McCallister. Hit like and subscribe, and I'll see you guys next time right here on the First Time Keys.